Okay. Is a narrow day. Okay. A cash generating unit comprising a factory, plant and equipment, etc., and associated purchased goodwill becomes impaired because the product it makes is overtaken by a technologically more advanced model produced by a competitor. The recoverable amount of the cash generating unit falls to $60 million, resulting in an impairment loss of $80 million allocated as follows. Goodwill, okay, the carrying amount before impairment and carrying amount after impairment. So goodwill had $40 million before impairment, patents with no market value, $20 million before impairment, tangible non-current assets with market value of $60 million had $80 million before impairment, and the total is $140 million. So goodwill had nil amounts after impairments, patent had nil after impairments, tangible non-current assets nil. I mean $60 million after impairment, and a total of $60 million. After 3 years, the entity makes a technological breakthrough of its own, and the recoverable amount of the cash generating unit increased to $90 million. The carrying amount of its tangible non-current assets had the impairment not occurred would have been $70 million required. Calculate the reversal of the impairment loss.
Okay. With your guidance, look at it critically.
Okay. So we had a total impairment loss of 80 million, leaving us with a recoverable amount of 60 million. And this 60 million had been allocated, goodwill had been totally satisfied, patents have been totally satisfied. So it's now remaining 20, impairment of 80 million, goodwill of 40, patent of 20. So I was thinking that since goodwill had been totally satisfied, patent had been totally satisfied, we should be having 40. Tangible non-current assets, market value of 60. So
what's your conclusion?
Yeah, my conclusion is that now that the position of the company is better than before, so there will be a reversal of the previously recognized impairments. So the current amount of tangible non-current assets that the impairment not occurred will be 70. So what I just want to say is that we are going to allocate that impairment gain first to the tangible non-current assets. So to bring it from this 60 to 70. I think that means if we have satisfied the tangible non-current assets of 70, there will still be $20 million remaining. So that 20 should go to patents. So that means that the 20 should go to patents that have been totally impaired before. So in this case, we'll not have anything to be recognized as liability since the 90 million naira increase had been totally allocated. So 70 had gone to the tangible non-current assets, 20 had gone to the patents, but nothing is going to goodwill simply because the reversal is not permitted under the provision of the standard.
Okay, let me give you some guidance. If you check here, you find out that the goodwill was impaired by how much initially?
It was impaired by 8 million.
40. That's why it is 0. 40 was allocated to the goodwill. 20 was allocated here. And 20 was allocated here. That's how we got the 80. This 80. Now, 3 years after, the entity has made a technological breakthrough of its own, techniques of its own. And the recoverable amount of charge electric unit has increased to what? To 90. Whereas the kind amount of tangible non-current assets at the impairment law occurred will have been 70. Now, what will happen? What amount can we reverse as impairment loss, or what amount can we recognize as impairment gain? Very simple. Now, if you look at goodwill, whether any condition approved or not, you know that is a no-no. Because any attempt to reverse it is an attempt to recognize what is required not to be recognized, which is an internally generated goodwill. But we should consider reversing that of patents and consider reversing that of tangible non-current assets. But there's a question mark on the patents. What is the question mark? A car generating unit comprising a factory, plant and equipment, etc., and associated purchase goodwill becomes impaired because the products. This is a product that you probably have obtained patent for. It makes is overtaken by what? More advanced what? Model and what? Technology. By who? By competitors, which means that patent has gone forever. But what has come in newly is a new breakthrough of technology, which means the patent of that particular product no longer adds value. And that also cannot reverse itself. Even though patent can reverse, in fact, impairment clause on patent can reverse, but this particular product no longer suffice because competitors has wiped that product out and the company have to now venture into another thing entirely. Therefore, this patent has also gone. What is left is the tangible non-current assets. And we should have reversed the entire value. You know, when you check it now, what has reversed is about amount that has reversed is the difference between 90 and 70, which is 20 million. But unfortunately, this 20 million, we can't reverse it all because any attempt to reverse 20 million, we reverse only to tangible assets. And tangible assets cannot be recognized above its value, given that impairment has never what? Occurred. Therefore, this 20 million will now only recognize a portion of it that will take 60 to what? To 70. And what is that? 10. Which means invariably 10 is our impairment gain, while the balance of other 10 cannot be recognized at all, because you must not recognize a reversal of impairment such that it will restate assets above the initial carrying amount, and that impairment loss has not occurred. Does that make sense?
Yes.
Now, on that basis, can you read the suggested answer here?
Okay. The reversal of the impairment loss is recognized to the extent that it increases the carrying amount of the tangible non-current assets to what it would have been had the impairment not taken place. That is, a reversal of the impairment loss of $10 million is recognized and the tangible non-current asset written back to $70 million. Reversal of the impairment is not recognized in relation to the patent because the effect of the external event that caused the original impairment has not reversed. The original product is still overtaken by a more advanced model. Reversal of an impairment of goodwill is not permitted under IAS 36.
You know the reason why it's not permitted. Can you reiterate that reason?
Okay, the reason why impairment of goodwill is not permitted under IAS 36 is simply because the goodwill that is allowed to be recognized in the financial statement must be a purchased goodwill that arises from business combination. So if we are reversing an impairment, it is more likely that the impairment gain will be associated with the effort of the business to boost performance, and that can be seen to mean the same thing as internally generated goodwill, which is not permitted. So because of this, reversal of impairment on goodwill will not be recognized.
Okay, thank you very much. Now we wrap it up with the disclosure requirements, and we are limiting it to general disclosure. Okay, now what are you required to disclose as a result of carrying out an impairment assessment on assets? An entity shall disclose the following for each class of assets. A, the amount of impairment losses recognized in profit or loss during the period and the line items of the statement of comprehensive income in which those impairment losses are included. B, the amount of reversal of impairment loss recognized in profit or loss during the period and the line items of the statement of comprehensive income in which those impairment losses are reversed. C, the amount of impairment losses on revalued assets recognized in other comprehensive income during the period. And D, the amount of reversal of impairment loss on revalued assets recognized in other comprehensive income during that period. Now, therefore, we wrap up all of this discussion reiterating the following: that impairment is determined by comparing the carrying amount of an asset with the recoverable amount, whereas the recoverable amount is the higher of the fair value less cost of disposal and its value in use. Lastly, when it is not possible or practicable to calculate recoverable amount for a single asset, then such assets will have to be subjected to impairment assessment on the basis of cash generating units. And practical examples of such include goodwill and corporate assets. That is all for our discussion, extensive discussion on IAS 36, impairment of assets. Any other question as we round it up? Okay, in the absence of no question, thank you very much, and God bless you all.
Amen.